Well, the twisting, the easing, and zero interest rate policy, it all continues, but some are warning that additional stimulus measures could lead to harmful inflation. Representative Ron Paul has been among the most vocal critics of Chairman Bernanke, making "End the Fed" a rallying cry of his 2012 presidential bid. He joins us right now from Capitol Hill with his reaction to today's Fed action. Representative Ron Paul, welcome back to Street Smart. Great to have you here.
Thank you.
So, Representative,
good to be with you.
Your reaction to the move out of the Fed today, $40 billion worth of mortgage-backed security bond buying each month for an undefinable period of time.
Well, it shouldn't surprise anybody, but it's still astounding. To me, it's so astounding that it doesn't collapse the markets. I mean, he's saying, hey, we're in very big trouble. We're going to do something unprecedented, and we believe it won't hurt the dollar. And yet the stocks say, hey, we love this stuff. But the dollar didn't do so well today, and the real value of a dollar is measured against gold, and gold skyrocketed from its very low to its highest. It was like a $60 shift. So it means that we're weakening the dollar. We're trying to liquidate our debt through inflation, and the consequence of what the Fed is doing is a lot more than just the CPI. It's all has to do with malinvestment and people doing the wrong things at the wrong time. And believe me, there's plenty of that. And the one thing that Bernanke has not achieved that frustrates him, I can tell, is he gets no economic growth. He doesn't do anything with the unemployment numbers. And from my viewpoint, I think the country should have panicked over the fact of what the Fed is saying, that we've lost control, and the only thing we have left is massively creating new money out of thin air, which hasn't worked before, and it's not going to work this time.
Is there an unintended consequence here, a danger perhaps that, as you point out, that one, they're basically saying things are pretty bad, so bad that we're just going to continue this bond buying program indefinitely. We're going to keep interest rates low through 2015. Is there an unintended consequence in that they may be causing some people to say, well, all right, I don't need to go out and invest now. I don't need to buy a new house now. I don't need to invest in a new infrastructure plant or hiring new employees because I've got this money that's going to be so cheap through 2015.
Yeah. Well, I think really the biggest unintended consequences, what we need is a restoration of confidence. And if the Fed is expressing lack of confidence and they don't know what to do, I would say that it doesn't do anything to restore confidence. And like you say, people might restrain from doing anything. Interest rates are low. I don't have to buy my house this year. I'll wait till next year. It might be a little easier. The prices might come down. So people are restrained. It's sort of opposite of when you expect that housing prices are going up and you're afraid interest rates are going to go up. See, that's why the market rate of interest is so crucial. The rate of interest should give the businessman, the investors, the entrepreneurs, and the savers information. But there's no market to interest rates, and that's why there's such gross distortion and why we don't have a market economy. We have a rigged economy through central economic planning by central banking, and the whole system is failing and was doomed to fail, and we have to wake up to that fact.
Representative Paul, I know you're very worried about inflation. Does the Fed need real discipline here, and how would you go about getting it?
Well, short of getting rid of the Fed, which isn't going to come, and I wouldn't do that overnight anyway, I would say that Congress has the authority to say don't buy debt. Don't buy any debt. It's the fact that the Congress, they can yell and scream and pander to the people, say, oh, these deficits are terrible and terrible, but nobody wants to cut overseas spending and nobody wants to cut food stamps for the poor. So they say, but we can't do it without the Fed. The Fed has to buy this debt. So that's a moral hazard for the politician. So if the Fed couldn't buy the debt and interest rates would rise, all of a sudden the burden would be on the Congress to get their house in order and to restore confidence. But even that, that would panic a lot of people, because that meant, you mean live within your means? No, we don't like that. We like this idea that we can give people anything they want for free so we can get reelected. Well, but all this is coming to an end.
Representative Paul, I read your press release you put out earlier today, and you very wryly stated that clearly the Chairman Bernanke hasn't realized that it was excessive liquidity which created the problem in the first place. But if I read between the lines, does that suggest that he should be doing the opposite, pulling back liquidity, raising rates right now?
Well, the liquidity should be determined by the market. I don't think he should raise rates. He should just get out of rigging rates. I think the market should determine it. It should determine on savings. You know, the system is so biased. It helps the bankers who get free money and then they buy government debt. But what about the people who are frightened? They don't like the stock market and they're frugal and want to take care of themselves. And what do they get? 1% on a CD? That's unfair. And it's bad economics. So you want to let the market determine interest rates and let it sort it out. And people get so nervous because we've lived so long with a Keynesian economic model of fixing interest rates and intervening in the marketplace. The market still works. We allow the market to work in so many other areas. Commodities basically are determined by markets. But when it comes to the price of money, people think it's inconceivable that you could allow the market to determine interest rates. That is what is so important.
Okay, we have 10 seconds left. Would Mitt Romney, if he were president, would he do the right thing, in your opinion, when it comes to the Fed?
Well, so far I haven't heard that he would, but he has changed his mind before. So if he gets to be president, we'll keep our fingers crossed.
All right. Representative Paul, thank you very much. Good to have you back on Street Smart.
You're welcome.